if you are way outside of that typical comp, it could hurt you in the long run, either by profitability, you're not able to sell, your internal perpetuation could get messed up. So it's really important to be looking at your compensation plan because it makes up over 50% of your expenses. Welcome to the Insurance Refocused podcast, where we're highlighting real agent stories and how they are innovating to respond to the changes and challenges happening in the independent insurance industry. My name's Lindsay, and I can't wait to introduce you to my amazing co-host, who just so happens to be my mom, Carey Wallace. Mom, how you doing today?
I'm having a good day, Lindsay. How's your day start? How's the start to your day going?
It's going good. We got in the gym this morning. I knocked out a little walk when I got home, so I am feeling pumped and ready for the day today.
Awesome. It's a Monday.
It is. So today, obviously, we are doing a solo episode. We don't have a guest here with us today. And one of the things that I was hoping we could talk about is compensation for employees in an insurance agency. I think this is such a topic that is a big black box in our industry because there is no standard and there are so many different ways to do it, so many different, scales at which agencies have done this. And ultimately, people are the biggest resource and expense in an agency. So when it comes to buying, selling, perpetuating an agency, like compensation for their people is incredibly, incredibly important.
It's actually, it's one of the most important decisions you make as an independent agency owner. Like if you can't get the compensation right, it makes up almost 50% of your budget. So if it's off, it becomes really tough to correct, just so you know. Like it is, in the scheme of all the decisions you make as a business owner, finding the right people, compensating the right people, picking the right structure, staffing is one of the biggest decisions you make, right?
Yeah. Well, and you go into these, conferences or in a Facebook group or on LinkedIn or whatever, and you see people asking questions about how do you comp your people? What does that look like? You even see people who are working in an agency asking, hey, is this fair? And the comments are incredibly polarizing. Some are saying, yes, that's fair. Some are saying, no, absolutely not. Here's what I do. And it's a huge, huge black box. So one of the biggest things I think that I'd like to discuss today are like, what are the common comp models that work really well that you've seen, help push growth? And what are some that you've seen that you're like, OMG, never do that again?
Yeah. Yeah, it's a great question. And you're right. When you go online, people come from many different perspectives. When you're reading something online, you have to be aware, like, number one, you could be a startup agency. You could be an agency that is in, a captive. You could be an agency that has a very unique structure where they don't do any service. You have to know who the person is that's talking to put context to these things. But if we're talking about independent insurance agencies that are not captive, that provide sales and service to their clients, there are some standards in the industry for compensation. And there's a lot of reasons why people vary from these comp structures. Number one, if you're a small business, you might have blended roles and be trying to navigate between this person is part sales, part service, part admin, part marketing, part whatever. And so picking a comp structure that matches what they do doesn't fit neatly in a box of they are a CSR, they are an account manager, they are an administrative person, or they are a producer. So let's just be clear. There's a lot of challenges because we're small businesses. Many people wear many different hats. But if we're talking about the pure producer role where your number one job is to write new business and drive the organic growth of the organization, a compensation structure where it's 45% new, 30% renewal is what's standard. If, and listen, I'm going to say around 45 new, 30 renewal, because if it's personal lines heavy, it could be different. If it's commercial lines heavy, it could be different. It's definitely different if it's benefits focused, but our focus is on P&C insurance agencies. So the way to think about this is, how do you get someone compensated in a way that they can live while they're building a book and they're able to survive on the commission structure that I just said? There's two ways. You could have a base pay that then diminishes over time as they build their book. You could have a draw that's covered. You don't make any commission until you cover your draw in the first couple months. But the answer isn't offer 80% new, 80% renewal until someone builds a book, because it's really difficult to back away from high commission structure. That's probably one of the biggest problems that I see, is someone has a comp structure that's so outside the norm, and it's difficult to back away from that comp structure.
Right. Well, and I feel like that's where a lot of times people are coming to us and we're getting involved, because one of our CFO clients is buying an agency and their comp structure is just so completely different than what that agency is, and that they can't blend together. So some of those ones that are 80/80, you literally inhibit yourself from selling your agency by doing that, which is insane to me. That's something I never even thought about.
And think about that. When I say that, some people look at me like, what do you mean? How can that inhibit the sale of my agency? But as a buyer, if you're looking at a comp structure that's so different than the industry average, and the seller wants to get top dollar for their agency and has expectations about the price, as a buyer, my choices are, I can buy the agency and correct the compensation and run the risk of losing someone who's going to drive future performance in the agency or the growth, or I can say, you have to correct the compensation so you can achieve the profitability level that will drive the price for your agency. Again, still there's a risk that if anybody changes that producer's compensation structure, they're not going to stay with the agency, and the agency's not as valuable as it once was. Never mind the risk of losing customers when the producer leaves, but the risk of that agency not continuing to perform is also a problem. So the predictability of that agency becomes less certain, because there's a comp structure that has to be changed. And the reality is, nobody likes change to begin with. They certainly don't like change with a comp adjustment. That is a surefire way to have someone not be happy with a transition or an acquisition, right?
Yeah. Well, especially if it's going down. I feel like if it's going up, it allows for a little bit more flexibility and, camaraderie and building trust with the new org. But if their only way to go is down, I think that that's really tough. Or if there's just even like a major change, like you're changing it to be more base and less commission, and it's, untrustworthy, even if the person's going to be making more, it's really tough. So I think it's important to stay within those industry standard comp areas, so that that's not something that you ever have to worry about.
Yeah, absolutely. So the other thing that I would just talk about is, even if you set up a comp structure that is base pay, new commission, and renewal commission, you also need to put a threshold on what you're paying a producer for renewal commission. And here's the reasons why. As an agency owner, once that producer's book gets to a certain size, he or she will require service or a account manager, a CSR, to help retain that book. If you don't do this, you have producers that are responsible for retaining the book and selling new, and they won't have the capacity to continue to write the new business. It just makes sense. If you do not put that threshold in, meaning the producer only gets paid for the accounts that they need to be involved in the retention, and therefore other accounts that are smaller than that become house accounts where your CSR or your account manager is covering them, the profitability of the agency will suffer, and the time that the producer is required to stay involved will suffer, and therefore their performance will suffer as a producer. So setting that expectation up in advance to say, listen, we are going to stratify your book and have you only compensated after year one on the accounts that you are helping renew. Everything else becomes a house account. And again, be able to model out what is needed in new business, what is the expected retained business, and what is their expected compensation. It makes it much cleaner and easier for everyone involved and sets everybody up for success. The thing that, you have to remember is producers are focused on new and maybe not the most detail-oriented people on the planet that wants to do the detailed work in order to retain the book. So this is a win-win when it's done correctly. It is not done, if it's not done up front, it could actually be an area or source of pain for the agency to retroactively apply this. So it's a really important thing to think about.
Well, I think the other thing that's worth mentioning here, if we're talking about retention and getting paid differently on new versus renewal comp or renewal policies, is make sure your data is accurate. In a time right now where we have so many rewrites happening, not every system recognizes a rewrite as a rewrite automatically, right? Like, have you been seeing any errors with that in I don't want to say the agencies that we work with, but has that been something that has come up ever?
Yeah. So all the time, actually. So when a policy downloads, it downloads new to the carrier, but it's actually an account that the agency has had for many, many years. It was just rewritten from one carrier to the other. If your agency is paying 45 new, 30 renewal, and you do not have a process in place to catch that and reclassify that as a rewrite, you just paid 45%. You paid an extra 15% commission on something that is not new. So if you don't have strong policies in place, it becomes difficult to make sure that you're compensating appropriately. The other challenge is that should be monitored and checked by someone other than your producers, and something that is a policy across the agency. So that many agencies, to deal with that challenge, will say, don't worry about it. We're just going to pay 50 new, 50 renewal. The problem with the structure that's 50-50 or 40-40 or 45-45, you are incentivizing your producers to do the same amount of work on new and renewal. And once a book gets to a certain size, you are literally incentivizing not a lot of work, just sit on the book and help it renew, which is not a growth-oriented strategy. So your comp structure needs to match what you want your producers to do, not create ease and an administrative challenge that we all know exists, but that actually could hurt the agency from a performance standpoint because you're not incenting new business at all in that type of structure.
Yeah. I think another important topic to chat about with that is, that might look differently in a super small or early stage org versus an agency who's been around the block and already has existing producers and might even have like a producer training type program that they work with. But the transition between each of those stages as the agency grows, so not even when you're selling your agency, but just as the agency itself grows, how have you seen those transitions go?
Meaning you have one comp structure and you need to move to another?
Yeah, like you were a startup agency, you got through your first 5 years, and now the agency is in a completely different spot than it was before. If you weren't thinking that way when you were a startup agency and you were just like, get me a producer, let's go, let's hit the ground running.
Yeah.
And now you're an established org and you need to actually, be a little bit more strategic. Have you helped anyone through those types of changes?
We actually have a lot of agencies that come to us and say, hey, I'd love a valuation of our agency. And it's very clear when you do the valuation, their comp structure has some flaws in it. And so the question is now, how do I fix my compensation? What are the steps that I can do? And typically we do an analysis of all of their people and figure out what's their size of their book, what is their ongoing responsibility in the agency, and step them from one comp structure to another over time in order to make sure that the agency is solid, the employee is solid, and we could introduce things like deferred comp or, potentially other incentives other than their current comp structure to make up for the shortfalls of one comp structure to another. And it really is a case by case situation. It could be that those employees just need to know you're at the max of compensation where you are today, and it'll take you some time in order to get to the next comp structure. So without taking on more work, this is the max amount of compensation that you can have. But it really is on a case by case basis what we need to do. You need to be thoughtful of the value of that employee, what their current responsibilities are, other people that are having to work with with that employee in order to complete that work. And typically it's based on an honest conversation about what that looks like and a longer than one cycle in order to get it back on track. None of these things happened overnight. It's not realistic to think you're going to fix a comp structure overnight. And for that reason, if you're thinking about selling in the next 5 to 7 years and you think, oh goodness, we have a comp structure that you've touched on here. Maybe we need to right size it. Give yourself runway to figure out how to right size that. It might mean there's phantom stock or deferred comp or a minority ownership for a key employee that you want to retain, but you also want to get their comp structure set. So if there's plenty of time, it can be rectified. If you want to sell in 6 months, you have that challenge that will impact the future performance of your agency and potentially the future makeup of the staff of your agency. So getting in and getting getting your hands dirty and figuring it out in advance is beneficial to everyone involved. Time is your friend in this situation, or it can be your enemy.
Yeah. So in summary of this episode, let's go over some of the things we talked about. So not normal. I got to stop saying normal. Typical comp structure that's about industry average is 30 new, 40 new, 30 renewal, you said?
45 new, 30 renewal, yes.
45 new, 30 renewal. If you are way outside of that typical comp, it could hurt you in the long run, either by profitability, you're not able to sell, your internal perpetuation could get messed up. So it's really important to be looking at your compensation plan because it makes up over 50% of your expenses.
Yes.
The other thing we talked about was making sure that your data is clean and you're not paying new on a rewrite. So really got to look at that, make sure that is in track. Give yourself a long time to change between different models. Doesn't matter if it's you're selling to someone, doesn't matter if you just grew enough that now it's time for a change. Give yourself a long runway in order to do that.
Yep.
What else? What did I miss that was like a really important takeaway from this one?
Communication. I think talking to your people and explaining to them why you're making changes, how they impact the agency, how much you value them is important in all of this. It's not just a numbers game. It's about setting up your agency for success. And I don't want to miss that. There's a lot of producers that want resources from their agency in order to be successful. Well, if you're overcompensating, you're double paying for retention, you won't be able to invest in the systems or the marketing or the other things that people need. So be clear to your staff why these changes are incredibly important, how much how much you care about them, and how you're going to fix them so we can create a win-win. And I know that sounds crazy, but transparency builds trust And trust builds loyalty. And this is a relationship business. So I think being as clear and honest as you can be creates a win-win for everyone.
Absolutely. All right. So that was employee comp. We will be back soon with some more solo episodes, and we'll catch you next time. Thanks for listening.
See you, Linz.
Thanks so much for tuning in to the Insurance Refocused podcast. If you enjoyed the episode, please be sure to hit subscribe and leave us a review so you'll never miss us. Want to learn more about how Agency Focus can help you grow your agency? Head to agency-focus.com or email Carey directly at carey@agency-focus.com. If you need to get in touch with me, feel free to shoot me an email at lindsay@agency-focus.com. Thanks so much for tuning in. We'll see you next week.